When business owners sell their company, one important factor that often surprises them is taxation. The sale of a business can trigger significant tax obligations depending on how the transaction is structured. Understanding these tax implications is essential when planning a successful exit. One key factor that affects taxes is whether the transaction is structured as an asset sale or a stock sale. In an asset sale, the buyer purchases specific assets of the business, such as equipment, inventory, intellectual property, and customer relationships. Each of these assets may be taxed differently depending on how they are classified. For example, some assets may be taxed as ordinary income, while others may qualify for capital gains treatment. In a stock sale, the buyer purchases the ownership shares of the company instead of individual assets. For many sellers, stock sales can result in more favorable tax treatment because the proceeds may be taxed as long-term capital gains. However, not all transactions qualify for this structure. Another important factor is how the purchase price is allocated across different assets. The allocation of the purchase price can significantly affect how much tax the seller ultimately pays. Because of these complexities, tax planning should begin well before the business is sold. Business owners often work with accountants, tax advisors, and transaction professionals to structure the deal in the most tax-efficient way possible. Proper planning can sometimes reduce tax exposure and help sellers retain more of the proceeds from the sale. Taxes are a critical part of every business exit, and understanding them early can make a major difference in the final outcome. EIN Business Brokers. We represent you in business sales and acquisitions. Confidential, structured, executed.